Still on the third part, specific data to look for when analyzing major economies. And we are moving on with the Eurozone economy, the eighth indicator. And one of the most important ones to watch is represented by the core CPI. Now CPI stands for Consumer Price Index, and this one is the most important, or the favorite indicator in measuring inflation for all the central banks in the world. Whenever you are seeing that the CPI is being released, regardless if this is in Eurozone, United States of America, Australia, UK, Canada, or whatever, Japan, regardless the economy, whenever you are seeing that the CPI is being released, that has the inflation name written all over the indicator, and central bankers take these indicators into consideration, because in every mandate of each central bank in the world there is the goal or the target to keep inflation at a specific level. The normal level for inflation, or the mandate for the important central banks in the world, is to keep inflation below or close to 2%, not below 0, not higher than 2 to, I don't know, 4 or 6 values, but below or close to 2%. Specific inflation levels, not necessarily high levels of inflation like I don't know, 4 or 5 or 6 rampant inflation, but specific levels of inflation, something like 1%, 1.5%, 1.6%, 1.8%, are healthy for economy, as they go hand in hand with expanding economy. However, negative inflation, in free translation, deflation, is dangerous for the whole economy, and actually is being interpreted as being more dangerous than the inflation itself. Now the CPI, the Consumer Price Index, is the favored indicator in measuring inflation, and inflation, like mentioned earlier, is on any central bank in the world's mandate. A normal mandate in fighting inflation is to keep inflation below or close to 2%, and this might seem an easy task, but it is not, as a lower level of inflation, like expressed earlier, brings deflation, deflation risks, and higher level of inflation are difficult to control. So keeping a balanced level around the 2% area is the goal of any central bank. The core CPI tends to show the change in the price of goods and services purchased by consumers, excluding food, energy, alcohol, and tobacco. These last goods are considered to be volatile and to distort the actual number, and this is why they are excluded from the core release. This indicator is being released by the Eurostat in Europe, and if the actual comes in higher than the forecast, it should be interpreted as being positive for the currency. If the actual is lower than the forecast, then it should be interpreted negative for the currency. Now let's make an exercise. Let's imagine that the actual core CPI, it is coming, I don't know, at 3 point something percent, then and the forecast would have been something like 2%. So 1% difference between the actual and the forecast, and normally the currency, the single currency, the euro, should be boosted higher. Why? Because high levels of inflation should be translated in raising the interest rates from the central banks, and normally the ECB should increase the interest rates in order for inflation levels to be kept under control. The same with the negative, or with the actual coming in lower than the forecast. If, for example, you have an inflation forecast of 3% and the actual is going to come in something like 1 point something percent, then it should be interpreted negative for the currency, because central bank, the ECB, would most likely move into, or will signal the disponibility, if you say the reducing of interest rates on the next session, on the next meeting. The core data on the CPI has a mild impact relative to other countries due to the overall CPI being the central bank's mandated target. Like explained earlier 2 times, I'm not going to mention it again, 2% inflation target. It is released monthly, about 16 days after the month ends. The release time is 9 GMT during the London trading session, and this one is the first tier data, but I mean the first tier data. High volatility expected, especially if the actual differs than the forecast. This is one scrutinized indicator from the whole market participants. If you are looking at the past 6-month data in Europe that we are analyzing, starting with February 2013 and going into July, and this indicator is being released on a percentage base, and you are looking at February 1.3%, so normal levels of inflation, then 1.3% February, March, April 1.5%, 1% in May, 1.2 and 1.2 in June and July. You might say that the inflation is subdued, the inflation threat is subdued, the inflation levels are subdued, and inflation poses no risks. It is quite funny with all these quantitative easing programs running all over the world. In the United States, the quantitative easing program is called the QE. In the UK, it's being called the Asset Purchase Facility. In Europe, basically, the quantitative easing are being represented by all those bailouts or helping packages that the ECB and Europe as a whole have transferred to Greece, Portugal. So easing going all over the place, monetary easing all over the place, interest rates levels at historical low levels, and yet inflation refuses to go up. Okay, it is not going into the negative territory, which is good, but it's not going up. Going into trying to interpret the data that you are seeing here, we're looking at something irrelevant, I might say, between 1 and 2%, between 1 and 1.5%, threatening to the downside on the deflationary area. But I would say that central bank would most likely be happy with the CPI, with the core CPI, to print value somewhere between 1.5 and 2%. Remember the mandate for the ECB to keep inflation below or close to 2%. Now, 1% is not close to 2%, so that would be a bit trouble for the future. We'll move on to look at the German ZU economic sentiment, and the ZU comes from Zentrum für Europäische Wirtschaftung GmbH, and that means the Center for European Economic Research, and this is one of the most important indicators out of Europe. But we'll take a look at that on the next recording. What to keep in mind under this one, that the core CPI is being released on a monthly basis, about 16 days after the month ends. The release time is 9 GMT during the London trading session, and this is a first tier data, one of the most important out of Europe. Expect volatility. Let's move on with German ZU, or ZEW if you want, economic sentiment.